So, Brian Belski, we just closed out this awful quarter. Now what?
Well, let's try to swipe the slate clean, Scott. I mean, obviously, this is unprecedented. We don't have a roadmap. And I think that's the biggest problem, quite frankly. There are some decent signs that we've seen, not just because, the market rallied last week, but we're starting to see more signs of rational trading overall. And I think that remains to be seen in terms of what's really going to drive the market going forward. But clearly, we're still so focused on COVID. The one thing that has been just unbelievable in terms of our calls, and I was on 10 client calls today, 10 out of 10, Scott, think that we're going to go back and retest the lows. So that's very consensus. It's not just hedge funds. It's traditional money managers as well. So I don't know how to read that exactly because, again, unprecedented times. But we continue to stand behind our call that we made on your show last Monday night saying that we believe that stocks were going to rally 40 to 50% from the lows because we do believe this too shall pass. And the majority of this sell-off has been fear-driven because of the information that we don't know. Now that we're starting to see more information, meaning bad news on the economy, interest rates, what oil is doing, I think we can deal with that. We're used to dealing with data and information, not fear.
Sri, if Brian Belski would have called you today, he would have had 11 people who suggested we were going to test the lows because that's where you think we're going, right?
Yeah, I think we are headed much lower, Scott, and there are a variety of reasons for that. One is that the economic decline that I anticipate for the second and third quarters has not yet fully registered in equity prices. I think that has to happen. And then once we see the coronavirus deaths accelerating for a few more weeks before we crest and start to go down, that is going to have a second impact. Third, it is not as if the economy can switch on and switch off. Even after the third quarter, we are going to have a situation where the supply chains are affected, and you're not going to come back to normal until early 2021. None of that is figured into equity prices, so I think they have quite a while to go. And I had been anticipating a recession even before the coronavirus came along. This has strengthened my conclusion that it is happening right now and that it is going to be much deeper than I had feared before.
So, Brian, to Sri's point, how is the market going to deal with the numbers? And it's not just the economic numbers. The numbers out of New York are going to be difficult.
They are. And quite frankly, the market actually has already discounted a recession. We pulled into a classic cyclical bear market. We wrote about that in our notes to clients last night. But you can have a cyclical bear within a secular bull. So how are we going to deal with this is your question, Scott. And we know that New York is the epicenter. And we know that the financial services and the media run through New York. So it's very, very close to our hearts and it's affecting us. But there's no doubt that there's still going to be bad news. However, we continue to believe that we're starting to see the signs of less bad news. And that doesn't mean the bottom's in shape. It doesn't mean that we're not going to go down from here. It just means that we do actually believe that we can see unprecedented moves to the upside. And I disagree with the notion that you can't turn on the economy. Remember, stock market's correlation to GDP is very low. And so I think if we're using too many traditional macro factors, that's not the right way of thinking about this. Think about all the pent-up spending that's happened, or pent-up spending that's waiting to be done. Also, the very strong online moves that we've seen. I think the market is just willing and just waiting to get a breath of fresh air, and I think it's coming.
Sri?
Scott, I would disagree. I think that to call a rally right now is premature. You're probably at least 3-4 months too early doing that. I agree that equity markets are likely to presage the economic recovery taking place. But even that has a while to go. And again, we are looking for dividend cutbacks, restrictions on what companies are allowed to do. And the restrictions the government is going to put in exchange for the bailout, unlike the post-2008 bailouts, this is going to be a much stricter plan that is being done. While that is good in the long term, it is essentially improves the structure. It is going to be negative in the short term in terms of equity prices. And I think that is not figured in. I think the market thinks this is more like a March 2009 low. And then with that, the market picking up again. I think this is a very different situation. This is a different kind of a recession and a different kind of a correction. And I think the path is also going to be radically different. That's why I think it is going to be a long-drawn one. Second, I am a big believer in the message which is coming from the bond market, which is what had led me to look for a recession even before. And despite the rally that we had 3 days last week, the 10-year yield has continued to remain very low, and since in the last 3 days has gone down some 20 basis points. That is also indicating economic weakness, something the stock market does not pick up and has never picked up adequately as the bond market has done.
Brian, quick, the last word goes to you. I saw you shaking your head as Sri was talking.
TARP was $700 billion. The government made money on the $483 billion that it actually told out. It was not only the banks, but it was also the autos. The $60 billion that we've seen in terms of what's going to be hopefully helping out some of the industrials, those are the companies that are not going to be pay dividends or buy back stock. It does not apply to the rest of the market, and I do not believe that's the right way of thinking about this. Equity income is going to be a very, very important part of what's going to happen in terms of quality coming out of this, and that's why U.S. stocks are going to continue to get money, especially from around the world.
This debate will continue. Gentlemen, thank you very much for being with us. Brian Belski, Sri-Kumar, it's good to talk to you both this evening.